As today's episode is broadcasted offline, there won't be a chat going live. But if you have any questions, just put it in the comment section below the video. So today's episode will be devoted to stock market, crypto, indexes, everything about where the money flows. So without any further ado, let's head. Alright, so let's head on to our presentation and let's find out what's going on with USA. So for this, I wanted to just jump on to artificial intelligence, Google Trends, and you can find right here that interest over time is dropping worldwide. So despite US small businesses are adopting artificial intelligence, there is still, I would say, many type of a hyped content, many of the content that is making the valuations soaring, sometimes out of non-foundations. And I have noticed lately that it's not an adoption that is aligning the most frenzy type of invested companies, but that's media that are adopting the headlines in order to grab the attention of the viewer, of the reader. And that is why widely we have had a correction on the broader stock market, and that is why we need to be really cautious in finding out any type of certainties and uncertainties around what's going on really in this AI types of hyped world. It is very easily to get caught into a trap. It's very difficult for many of those companies to monetize AI, and right now these valuations are mainly pushed by just expectations regarding future. And right now let's head on to where we are right now at the table of interest rates. And it looks like economists have adjusted their expectations regarding Federal Reserve's actions, delaying their prediction of an interest rate cut to the first quarter of the next year. This contrast with the earlier belief that rates would be lowered in the final months of this year. And despite the change, their outlook for the peak level of the Fed's benchmark interest rate remains consistent with its current target range. We also had a survey being run by National Association for Business Economics that revealed a split opinion on the possibility of US recession among the investors. But right now, if we just wonder about what happens after the pause in interest rates, when cuts eventually come over, in 90% of times in the history we had a recession. So betting against that will happen, and that this time will be different is quite unreasonable. And when talking about recession, we need to talk as well about the debt. So it's a common fact that monetary and fiscal authorities are pursuing unsustainable policies. So central banks are increasing the cost of debt and reducing balance sheet assets right now, which really contradicts the growing government debt. So that's the post-COVID era. The rapidly increasing debt burden is nearing historical levels and is expected to continue growing further. So in order to having this situation under control, it's likely that central banks led by the Fed will become the primary financiers of government debt, with quantitative tightening policies resembling a kind of a illusionary debt ceiling that must be consistently reversed in practice ultimately. And when talking about the probability of occurrence of recession, we can't really scared the fact that treasury yields right now at the very, very high level, over 4%. So US 30-year bond yields hit a high of 4.42 back in 2011, while 10-year yields approached 2007 levels. Historical data shows, however, that in previous Fed rate hike cycles, yields often exceeded the Fed's target rate before stabilizing. Typically, the 10-year yield peaked around the same time the Fed stopped raising rates, but this one might get eventually different, but we will see anyway. The current situation might be different due to the influence of the Fed's large balance sheet, which tends to keep yields lower. So investors betting on a bond market rally driven by a potential recession hope for a different outcome right now. When talking about, however, the conditions of crediting of banks, we can find right here that it has dropped to an unprecedented level. So it languished to right now around 0.0% change from a year ago. So US consumer credit is right now at the very plunged area. It may take many months in order to recover, and now consumer loan demand is eroding. So they are also repaying debt faster than the new debt, so shrinking the dollar supply, and it will be very difficult to tell about the growth in the economy if this persists. So US right now revolving credit contracted in June, and it's worth emphasizing that the very rarely falls outside of a crisis or end of a cycle recession. So you need to really see consecutive negative months with worse numbers for a decent signal, but with that being said, there's something going on and we need to be very cautious. And as we are at the federal types of things, let's talk about federal tax receipts that right now is in a real free fall. So US state and local governments faced their worst ever drop in income tax revenues, marking the second largest year-over-year decline in history after the global financial crisis. And we are finally need to also talk about the jobless market, the job market indeed. And non-farm payrolls have shown strong growth recently, but history shows that they typically decline 12 months after 10-year and 3 months yield curve inversion. So right now we are not in a recession, but it's still the answer of yet. So US private non-farm payrolls has increased in June, but overall non-farm payrolls, even though it's rising, it's still the time where we might be looking at the possible deterioration. So months after inversion of 10-year versus 3 months yield curve are still at the very infancy phase. So there is still possible months of a recession ahead, and that might be maybe somewhere around 2024. And when covering this thing, we need to talk about personal savings rate. So this thing is absolutely grounding. Right here you can find that we have aligned with the level that's been lately met in 2007. Personal savings rate back then was almost at around 5% of disposable personal income. Therefore, there is, I would say, very far from the boom that we are listening from every here and there in the media. That's why personal savings rate may indicate that we are rather in a very cautious territory in terms of return to this expanse type of a economic cycle. Taking all this, we need to remember that right now there's not the greatest time for the economy, and also that is remarked by bankruptcy surge. So look at here, 2023, in the first half of this year, bankruptcies in the United States reached their highest level since 2010, for companies covered by S&P Global Market Intelligence. So it's the one thing that may point that right now we have gone through the whole economic cycle with these bankruptcies have hit that high level post-pandemic, but still there are many things to cover yet. We haven't had a great inversion or recovery of inverted yield curve, so leading economics indicators are right now also inverted, and there are far from recovery gauges. And when talking about the possible assets for the times ahead, that might be definitely one that is right now an ETF frenzy. And I mean, of course, Bitcoin that has been attempting and striving for an ETF for itself. So BlackRock's Bitcoin ETF application spurred other firms to apply, and among them there are many regarding Wisdom Tree, Invesco Galaxy, ARK Invest, and also many lower types of names. So the rally began, and with this ETF spot being introduced, there is still a great chance that this bull market of 2023 will eventually lead to promising returns of this digital type of assets. So if we just consider that right now, excluding the latest drop, that's the performance since the beginning of a cycle, we still have a large rail to go. And looking at 2023 performance from the cycle's all-time high, there has been a powerful recovery resembling previous cycle recoveries. Except for 2019, similar moves of the bottom in the past cycles mark the start of a new cyclical uptrend. And could it happen this time? Let me know in the comments below the video. In today's episode, that's it. Thank you very much for sticking by, and we are seeing each other tomorrow at 8 a.m. ET time.